Welcome to the Agent Dashboard. This week, I want to talk about two topics that I think are going to help you in your business when explaining to clients where we see rates trending in the coming weeks and months, which we feel they'll be coming down. I'll explain why here in a second as I share the screen. The second is our new Payment Affordability Program that is designed to increase affordability for buyers in this market. And we're doing this in a multitude of ways. If you have listings that you would like to be able to get sold, and maybe they've been sitting on the market longer than in months or years past, there are ways that we can, instead of price reduction, show to kind of partner up with you and educate your seller on why a credit is going to be best served to increase the affordability for buyers and have more eyeballs come to your listing, more traffic it opens. And we want to partner up with you, and we have some great software and tools to be able to help support you in that journey. And so as I share the screen, one thing that we've noticed lately, and that, not to nerd out too much in the mortgage business stuff, but it's important for you as a real estate professional to kind of get at least a general idea of how all this works. What the 30-year fixed rates are go off of typically, and they move in lockstep tandem, is with the 10-year treasury. So if you Google, like, what's the 10-year treasury rate today, it's around 4.2% as of this recording. Typically, the spread between the 30-year fixed rates and the 10-year treasury on average is around 1.5% to 2%. So right now, if the 10-year treasury today is 4.2%, then we would think 30-year fixed rates with that normal spread would be 1.5% to 2% above the 10-year at 4.2%. So if you're running your calculator right there, 30-year fixed rates should be in the high fives, low sixes right now, between like 5.75 and 6.25% based on those normal spreads. If you look at the red here, those are 30-year fixed rates on average from 2015 up until last week here. I just updated this chart. The blue is the 10-year treasury. So look at this spread. Normally it's tighter. And then what's happened the last year and a half is this spread here has widened. Well, a couple of reasons behind that is because lenders in Fannie and Freddie who buy these loans in the secondary market from lenders, investors that originate mortgage loans, they think rates are coming down. And so what they're doing is they're marking rates higher right now to try to create revenue, because they feel strongly that whoever buys a house, today and gets a loan, they're not going to have it very long. And so they want to get that revenue and margin now, versus if you want a lower rate, you're going to have to pay points for it. And so right now, that's a good sign for you as a real estate professional to see, all right, the kind of where the smart money is and how they hedge kind of future business. They want consumers right now to take a higher rate so they can earn that interest income for the short duration they're likely going to have the loan for, because they foresee rates coming down. And that's a telltale sign right there, because of this higher gap difference. And so as the 10-year comes down, which it's starting to do, you'll see 30-year fixed rates come down naturally. But I think you'll also start to see this huge gap start to kind of get back to that normal spread margin of 1.5% to 2%. So I feel confident that in the coming weeks and months, you're going to see 30-year fixed rates down come rather aggressively to kind of get back to that standard 1.5% to 2% gap difference. Where right now, again, if rates are kind of in the high sixes, low sevens, they should actually be in the low sixes based on where, again, the normal spread between the 10-year and the 30-year fixed mortgages typically are. Okay, so that's something I can share this with you. If you'd like a copy of this, go ahead and reach out. I'm happy to get it to you. And then on our Payment Affordability Program, what this is designed to do is contact my team, and I want to be your partner to help you with anything right now at all on listings with buyers that need quick approvals, a different approach to get educated and be able to show numbers on. But the Payment Affordability Program it's a custom property analysis report that we create on your listing, and then we'll show different loan strategies based on a flex cash program where we cover a lot of the costs for the buyer, and we also can show them different strategies to increase their payment affordability. We have flyers we'll generate to send to you, and you can have those in hand for the buyer's agent or any buyers that walk into your opens. We have a website that's created for that you can use that has all this data on there. Yard signs that if you wanted to do that to kind of to show, this payment affordability program and how you as an agent are here to help affordability for buyers in this higher interest rate environment. And then again, we have lender discount opportunities. We're actually covering costs right now to help out buyers that maybe don't have a ton of cash, or just to sweeten the pot from an incentive standpoint to create eyeballs and attractiveness to your listings. And then we also have priority underwriting and processing that we're doing with our fast track approval. And we're doing 1-day full underwriting approvals right now. Quick speed matters. We want to be able to get this done for you on your listings with buyers that are interested in purchasing that listing. And again, this also applies as well to your individual buyers that you're currently showing that you may want to have them talk to a different lending team. My team and I are here to help with anything. That's it for today. Let me know if you have any questions. We'll be working all weekend, and just let me know if there's anything we can do to help. We'll talk to you soon. Take care.